Everyone, or good morning for those of you on the West Coast. Thank you for joining us for today's training with the mortgage calculator. Today we have a very interesting topic. This is definitely one uh, that you can use to add value, bring some value to the transaction. That's what it's all about in the industry when you are a loan consultant, right? There's a lot of people out there that the borrowers can choose. They're usually going to choose the individual that's they feel is going to get the job done in the best, most efficient, and most cost-effective manner. Today's training on credit rescore opportunities is definitely one of those where you can really gives you a great opportunity to shine and also a great opportunity to make the deal happen because many times that is what is missing or can be missing at the end of the transaction 2, 3, 4, 5 points to get you to the next tier where you need to be. So today's training is on unlocking borrower potential, exploring credit rescore opportunities. So let's get right into it. So as you can see there from the chart on the FICO score components, right? You have 35% of the FICO score or credit score, let's call it that, is from the payment history. 30% is from the balances, referred to there as amounts owed. 15% is on the length of the credit history, right? How old is the credit, the depth? 10% is on the credit mix, right? Between installment, revolving, right? Secured and unsecured. And the last 10% is on new credit, right? Because now breaking how these affect the borrower, and then we're going to get into how we use the tool because it's all about the MLO understanding how the algorithms work. And this is, it may vary a little bit between Experian, Equifax, TransUnion, right? There are a little bit difference in the algorithms, but it's more or less going to be the same. Uh, so payment history obviously has to do with if the accounts are paid on time. Uh, Amount sold is the balances. So um, payment history, as far as the credit report, there's not much you can do there. They have derogatory accounts unless there's actual errors that can be resolved quickly for a rescore. Like if they actually have a letter that says from the loan mortgage company or whoever is a servicer on that credit that says, yeah, John Doe, you were not late on that payment that you made that was marked late on your credit. So we have eliminated that late payment and we have sent notification to the credit bureaus that your payment was not late. Something to that effect that can be quickly remedied in a rescore. But they're disputing the account and starting the process at that point isn't going to help. So typically, what ends up happening in the rescores is that the focus usually is going to be more on the amounts owed to see what you can do or what the borrower can do if some revolving accounts are paid down. Because installment account balances, paying those down does not improve the credit score. And actually, paying off an installment account may reduce the borrower's credit score because now you eliminate that installment account from the mix of credit line amount, and now you may have increased their overall utilization. So understand how that works when you're doing your credit simulations. So, what exactly is a credit simulation or a credit simulator? It's basically a tool that allows the MLO or the borrower to simulate different credit scenarios and generates a simulated credit score. So that's why we're talking about going to the amounts owed and then reducing the amounts owed on the revolving accounts to see what can be done there as far as increasing the credit score. Now, you will note that, like I mentioned, the three bureaus each have a little differences in the algorithms. So you're going to note that the same account, if you would analyze it in three different bureaus, you would probably see differences in the movement of the credit score between the three bureaus. So it's not usual that you're going to have to update the borrower on all three bureaus. What may end up happening most of the time is you got to update the borrower on two bureaus because your middle score and your high score are the same and you need to get to the next tier. So rapid rescore is a process used by mortgage lenders and brokers where a fee is paid to the credit reporting company to have recent account changes updated in an expedited time frame. So basically, we're looking at a turnaround time on a rush scenario, maybe 3 days. On a regular non-rush scenarios, 5 days. That's all going to be dependent, obviously, on you providing the documentation that is going to be needed to be able to even request the rescore. And what you're talking about here is if it's a credit card account that's being paid down to whatever amount, let's say it's being paid down to $300 according to the simulation, then the borrower would need to pay the account down and then provide a letter given to them by the credit card company stating what the new balance is on some type of letterhead, identifying the account and identifying the balance, right? It has to be actual letter, PDF document. Now, it can be faxed is going to be the quickest way for the borrower to get it. Some creditors will email it, most will not. So the options would either be fax or send it via mail, which is going to take a while, a week to 2 weeks to be received. So normally fax is the option. Borrower provides that. Now, an alternative workaround to the letter is if your borrower is a little bit more savvy, they can go to the online account for the credit card company, and then they can take a screenshot of the page that clearly identifies the account number, or at least the last four of the account number, the URL on either the top or the bottom of the page showing that they're on the online account, the borrower name somewhere, and the balance, the current balance. And typically, if that is provided with all of those components, we can provide that document as the proof of the new balance. And then the rapid rescore can be ordered. And then hopefully within 3 to 5 days, you will be getting your update that, an email stating that the rescore is completed. So touching back on which one you would rescore, in the scenario where, for example, we had a low score of 630, a middle score of 650, and a high score of 655, and we're trying to reach a 660 middle score, let's say for a lot of non-QM loans, 660 seems to be the mark at which a lot of the action starts happening at good LTVs. So in this case, we would have to rescore the 650 and the 655 bureaus, whichever they are, to make sure that our middle score is a 660. If we do just the 650, then we're going to end up with a 655 middle score and vice versa. So when you're going to do the rescore, definitely make sure that you review all the information on the credit report for accuracy as well, because inaccurate information, including an incorrect address, can affect the credit score and the accounts that actually get reported. So you want to have everything as accurate as possible. Please note that the cost is going to be anywhere from $40 to $50 per account per bureau, right? So if you're rescoring that account in 2 bureaus, Experian and Equifax, for example, it's going to be times 2, the 40 or 50 times 2, and then that for each additional account, depending how many are being rescored. And please note, very important, that the cost of the rescore can never be charged to the borrower. If you do attempt to submit the order with borrower credit information, like a credit card or something, they will reject it. And then you have to start all over and then make sure that you input the proper method of payment that's going to be acceptable, but it cannot be from the borrower. Be aware and make sure you run this in the simulation that removing accounts from a dispute status may lower the credit score. So, before you run and tell the customer remove the dispute status, first see what happens to the credit score, because then if it goes down, then there may be some other additional activity like paying down an account or something for the to try to offset that decrease that just occurred from the account being taken out of dispute status. I know that's something that we need to do for an FHA loan, for example, to try to get it out of dispute status so that automated underwriting picks it up so that your findings are valid. Also for a DU or LP for a conventional loan, when you have the disputed account and the system wasn't able to provide the approval, or stated that if you're in dispute, you got a downgraded manual, which doesn't exist. This is, you would have to do the rapid rescore to get those disputes taken off so that the system AUS would pick it up again. If you were getting the denial or in the AUS on a conventional loan because of that. In an FHA loan, it's pre-written verbiage in the findings that if you have a disputed accounts with the aggregate of 1,000 or more, you got to downgrade to manual underwrite. So that's when you would embark on the mission to do a rescore on the disputed accounts, but be aware of what may happen to the credit score when you take it out of dispute status. Like I mentioned previously, paying down installment accounts also is not an option for a rapid rescore. Just mentioned about AUS approval to pick up the changes. Disputed accounts will need to be removed via rapid rescore. And 5 days is a turnaround time unless a rush fee is paid, which is like an extra, I think, $10, $15, $20 per account. Now, be aware there is a no doc option, right? That sounds enticing. You don't need the letter, any document or documentation from the borrower, but then do be aware of the risk that if you embark on the no doc option and it's not readily accepted by the account servicer, by the creditor, since there is not any documentation provided, then you run the risk of an extended review period of up to 30 days. So at that point, you probably would have to cancel, pay for another one, and then do it with the documentation. So no doc option sounds enticing, but if you really want to be sure to have that 3 to 5 day turnaround time, provide the needed documentation. Now, it's very important to note that borrowers can never order a rapid rescore. That can only be ordered by the broker or the lender, but never the borrower. And a very important point here: once when you order the rescore, they will build in a cost for the additional or the new credit report that needs to be ordered at the end, so that you will receive the updated scores. That's the only way to receive the updated scores. An actual new pull needs to be completed so that the new balances are reported and you get the new credit scores. So that will be included in the cost of the rescore when it does get billed to you. And again, that's the only way to get the new scores. Now, a couple of last points here, very important tips, because you want to make sure that after doing all this work and paying these fees, right, which is usually going to be paid by the MLO, right, cannot be paid by the borrower, you want to make sure that it's actually going to work, right? You want to make sure that the borrower does not open any new accounts unless opening up new accounts is part of the Rescore action plan. Sometimes that's what they say. Open up a new secured account, $500, and that could help your credit for somebody with limited credit. You want to make sure that they do not increase any balances on any installment nor revolving accounts. And what I mean by that is not the limit, not telling them increase my limit, just don't increase the balances. In other words, don't charge the credit cards any to balances any higher than the balances that were on the simulation report, right? Because if any of those other balances change on the other revolving accounts and installment accounts, guess what? The rescore will not work. The credit score will come in lower if the other credit account balances go up, sometimes even by $1. You never really know. And you want to make sure that the borrower does not close any accounts that have zero balances, nor close any accounts that are being paid down to zero, right? They can the idea is to decrease the credit utilization. In other words, the amounts owed in the chart that we see there, so that the credit score goes up. But if the other accounts increase, then the utilization is going to stay the same, and the credit rescore will not work. I actually had one that was a little frustrating. It was the borrower forgot that she had a very small bill of like $30 a month or $50 a month on auto debit. And she had it being paid by a credit card that only had like a $200 or $150 limit that she set up just for that auto debit. So in case the credit information was hacked for whatever reason, her liability would be limited to $150. But she forgot, and the auto debit payment hit, increased the utilization on that one card, and our rapid rescore came in short by 1 point. 1 point. And it was a rescore of like 4 accounts on 2 bureaus, so it was not cheap. And we were up by 1 point. We ended up doing the deal anyhow. We were just trying to better her rate scenario. So in the end, she understood what happened, and we had to close at the higher interest rate because of that one account that came in on an auto debit. So, just be on the lookout for that, because you want to make sure that you give that guidance all the way through the process. Get that rapid rescore. And let me explain, when, I always bring up credit simulations when I'm working with my borrowers, because I mentioned I like to add value, especially in a scenario where, they're at they need it, for example, right? It's one thing like they're at a 690, they need to be at a 700. That's 1 point. But also when it would make it a better deal, right? Where, okay, they're at a 700, they can get to a 740 with very minimal work on their part, very little usage of funds, maybe rescoring 1 or 2 accounts, and you add 20, 30, 40 points. Now their credit score is much better, and they're at a totally different tier, right? And maybe now that's a higher LTV, or maybe it's just a much lower interest rate. And let me tell you, sometimes you think, oh, I'm not going to do the rescore. I'm not going to, go on that mission. And then all of a sudden something happens at the end of the loan, and you're needing a couple of points to get to the next tier to save the loan. And you start thinking, man, I wish I would have brought up the rescore to the customer to see if they wanted to do that, because now if you would have done it, so it's always good never to, it's not good to operate near the extremes. Always good to give yourself a little buffer. So, and it's always good to bring it up, even if the customer says, no, I don't really want to do any of that. I'm fine the way it is. Okay, great. But you brought it up, you added value, put yourself as a loan consultant, right? Not as application taker, so that when the customer goes to refer a deal or do their next transaction, they're definitely going to think about you, and you're going to get all that business. So hopefully you all will absorb some of this and put it to good use. We definitely need customers out there getting all this kind of information. So I do see a couple of questions. Okay, first one here I see is, what about paying down the balances on your credit cards that should rise or raise your score? Yeah, we discussed that. That's revolving accounts. The revolving accounts are the only accounts that you can pay down that will improve your credit score. Okay, I don't think we have another question. So I'm going to give it a minute, see if anyone has any questions on the rapid rescore process. Definitely, you all saw the benefits here to everything. So looks like we're good. So I thank everybody for being on today's training on the fundamentals of rapid rescore, and look forward to seeing you all tomorrow.